Folks, AppLovin reported their Q1 earnings today. Huge beat, really great quarter. If you guys aren't familiar, this company was one of the hottest stocks of last year. Very good performance. It's a hyper growth stock in the ad tech space. I assume most of you guys are familiar, unless you guys are very new to this. But essentially, good top line growth. We're looking at 40%. Huge net income growth. Well over 100%. The advertising revenue, which is their main revenue, much more important, their apps revenue, grew at a whopping 71%. And the adjusted EBITDA also grew huge, and the margin is really good as well. I'm not a huge fan of these adjusted metrics, but it is a pretty good insight into their business. As you can see, very steady growth, whether it's the revenue, the net income, the adjusted EBITDA. The net margin is very good, 39% for the first quarter. With these ad tech businesses, typically back half weighted. So you'd probably be looking at maybe an upper 40% margin for the other quarters. They did a couple of buybacks, so slight decrease in the shares outstanding. On a year-over-year basis, an increase on outstanding, but if you look at fully diluted on a year-over-year basis, still a decrease, which is good. They're getting rid of their gaming business, which it's kind of garbage, so that's fine. Their balance sheet could be better. Slight decrease in the assets, largely because an impairment on the goodwill. But yeah, I don't think there's anything too interesting. And yeah, like I mentioned, the fully outstanding shares decreased, which is good. But yeah, nothing too interesting here. Like, I just wanted to point out that they had a great quarter. It's a very high quality business. If you're not long, you probably want to get long, although it's hard to say at what price. I don't really think they're cheap right now, but I also don't think they're expensive by any means, considering the rapid growth. I was a tad worried that they had too many advertisers like Shein or Temu, and that would hurt their business, but it seems like they're doing fine. They're one of those companies that purposely, that are sandbagging and keep doing the beat and raises. So given their pretty good guidance for Q2, given that's probably a beat, I mean, this company is doing very, very well. And, they've been doing things in a way that they have a lot of turnover. Very similar to Netflix. I think even more extreme, and it's proven that it's improved their business. They got high margins. CEO has been just executing all around. So this is one of those companies that you really do want to get long sooner or later, and perhaps you get long right away. I do think it'd probably be better to wait a bit, just because this company gets hit with short reports so often and downgrades, right? It'd be very, very likely that one day it gaps down like 5 to 10%, and that would probably create an okay entry. But yeah, overall, nothing too exciting, not too much to say other than that. This is really a great company, and they're performing in such a way that it's definitely worth owning for medium to long term. I'd say, just about finding the entry. But yeah, that's all for today.